Hello, if anybody's there. I am Al Mora, host of the Get MorAlpha Show. Today is March 16th. I have the wrong date up here. I can change that. I can work while I talk. Today's a very different day from any other day that I've had, because I've always had shows that are very much pre-planned and based on really like a full week of work per show. And I mean full-time weeks, okay? But this show is I created a lot of it just a minute ago, excuse me. Okay. And getting my water ready here. Okay. Okay, there it is. And but the reason for today's show is one more little detail here. Okay. All right. Whew, just got ready just now. Hold on. All right. I'm trying to make myself halfway presentable. Okay. Here we go. That's what you get when you get these homegrown shows. I don't have someone to do my makeup, et cetera, before the show. Okay, so today was historical because it was the largest point drop in the Dow Jones Industrial Average history. It wasn't the largest percentage drop, but we've had a series of days that have been pretty dreadful, and it's driven by the coronavirus news. It keeps building on itself, and excuse me. And so when I looked at what I prepared, it just was too academic and too sort of disconnected with what's going on real time right now. And I have been having daily each show I've done, I've had an update on the price earnings ratio and implied growth. We'll look at that guy again, but that's all I've done, and now I have quite a bit more of that. So let's get into our slides. Let's get our monitor going. I have promised myself now that I will never do a show without a monitor. I can always kill time. What happened today was I was preparing for this, and while I get my monitor going, I will share that today was a great day on a certain level for me, and this may be happening to a lot of us. I spoke on the phone a lot today with my family, with my dad, with my kids, with my grandkids, and it turned into hours of being on the phone, which was great. And that comes up again here in this today's presentation, that whole idea of how this is impacting me. So let's hit this button that I put up on Facebook. What I do when I monitor is I go all the way back to Facebook, and I do what I've asked you to do, because I've set up the button to on Facebook to get onto the show, and I go through that so that I know the buttons on Facebook are working, and it is. And then I set the monitor up. Pardon all the noise. Oh, it's got the sound. Let's turn the sound off. All right, there we go. Okay, so we're there. Monitor's working. Sound is working, obviously. Excuse me again. Okay. Okay, so now I'm calling this a Get MorAlpha Show special. Let's get into that presentation. Let's go full screen with it. Okay. It's kind of blinky in that other view, but full screen seems to be nice and stable. Okay, I'll make sure we're good. We have a little bit of latency when I monitor. I just want to make sure my full screen looks great for you. And then I'll get this going, and it looks great. All right. A little bit blinky, but no, there it goes. It's stabilized. Here we go. All right. There we go. So here's our roadmap, coronavirus. Okay, first topic. Then we'll look at the S&P 500 PE ratio. It's that ratio. That's the slide I've been looking at. So if you've seen the show before, you've seen the slide before. And then I have S&P 500 charts. So this is where I did some work today, charts and tables. And then I get back into return, volatility, beta, and alpha, and asset class comparison to remind us. The second half probably of today's show will be perspective that's not current. It's older data. It's from 2000 to 2018. But a very important part of what I'm trying to get through to people is, how do markets behave? So how does this new move, this big difficulty we're going through now, rank or feel compared with how markets behave? And from 2000 to 2018, from 2000, excuse me, to 2018 was an interesting period. Or maybe in 2010 to 2018. Oh, I got to look at the table again. No, it was 2000. Anyway, point being, all of this is to give you perspective, not only the current stuff that's going on in these first slides, but also more of a long-term. There's my date again. I will not leave this date on. This is just a sign that I was just editing this presentation. Here we go. We've got the right date there now. Okay. All righty. So let's get into this. Here's that price earnings ratio. Let me make sure I got the right presentation here. Let me look at something. I've done so much work on so many slides so fast that I just want to make sure. Yes, this is the correct. This is the correct presentation. Okay, good. Pardon me. All right, here we go. So from 1927 to 2019, all right, the year end, we have the price earnings ratio at the end of each year. Plus, we have March 13th, which was Friday. I did not get to update it for today. I wish I had. I did not have the time. That would have taken a few minutes. But I can help us understand where we are using this chart reasonably accurately, actually. Okay. So our price earnings ratio, the lowest it's ever been was 7 at a year end, and the highest, way over on the other side, on that side for you, is 71. And underneath there, what I have is implied growth and implied growth after inflation. And so let's look at the green one. That's the average. On average, the price earnings ratio is 17, meaning for every dollar that stocks earned in the S&P 500 in a year, in the past year, the average price was $17 at any given time. I'm going to say it again. The proportion between the stock prices that are on the S&P 500 and what they earned the year before was 17 to 1, 17 times. That was the average. Pre-coronavirus, it was 25 times. That's the orange bar and the orange letters. And we've got that up on the right-hand side. We've got the average at 17 times up on that side for you. 25 times for pre-coronavirus. But now let's look at the bottom of the chart. Friday, March 13, not today, we were at 20 times. Today, we're lower. Today, we lost from 20, we lost another 10%. So now we're at 18. That's probably pretty darn accurate. So here's what we can take away from that. If the market could stabilize somehow right now, if life could become normal, if we didn't have coronavirus hitting us with news every 10 minutes, and if the market were down where it is right now, that would be a level for the market that I would say is sustainable. Because when we were up pre-coronavirus at 25 times, I had a whole show. My second show was about the fact that I couldn't imagine it was sustainable. Why? There are different ways of looking at it. To me, the best way to look at it is to know this. Any level of price earnings ratio implies earnings growth forever. Okay? And it is true, over average on time, stocks earn more per share on average. Companies earn more per share on average. So it is reasonable when you're pricing something to assume they will continue to grow earnings per share at some rate forever. Now, the real rate after inflation, the average real rate after inflation is 2%. Let's look at that. Let's find that. You see the word average popping up right above that word, right above the word. You see the word average blinking. That's the after inflation growth that is assumed when you have a 17 times price earnings ratio. That is actually saying, how productive are we? How much more productive can we be on average year after year? If we're going to increase earnings that much every year, after inflation, that's not just a number, an accounting number. That's a measure of how human beings, how good we are at improving our productivity. Okay, it's a proxy for measuring productivity. And if I could believe pre-coronavirus down there in orange, then I would believe that our real productivity as human beings, our growth per year, had doubled from 2% to 4%, and I don't believe that it has doubled in recent years. I can't believe it's higher than 2% because that 2% average takes into account from 1927. And I can tell you the chart does say that it has gradually been rising, but not 4% per year. And so Friday it was at 3% per year. And I started sharing that, hey, that could be sustainable. But now that we're down at 18 times, which implies a growth after inflation of just above 2%, I can believe it. I can believe that we can sustain that. Did somebody knock on my door? No, I didn't think so. Okay. So here, there are some conclusions. We are at a possible sustainable level today, but coronavirus could keep pushing us down, could keep pushing the market down because coronavirus is having a real impact on the economy. Sports are shut down. Schools are shutting down. All public events are being shut down. Restaurants are being closed, and they can only, in New York, and I think it's New Jersey and Connecticut, you can only sell pickup or delivery. The economy is going to be affected. My own son is in business. He called me today and we spoke about his business. He's already, orders are down immediately, right? And so we are all going to contend with this. And that's going to affect the market. And now maybe it's reasonable to expect that, hey, it could be worse than average soon, tomorrow, okay? All right, portfolio decision implications. When you're in a situation like this, lots of people many of you may, in fact, it's not that you may, I have no doubt that you've been calling, many of you have been calling investment managers, you've been watching TV, and you've heard from many people that it is not time to sell. It's time to buy and hold, grin and bear it, hang in there for the long haul. Well, if a person, how do you think people feel who sold 2 weeks ago? Do you think they are not glad they sold? Maybe they were overreactive, but were they? Look at let's just see what is happening. We're going to see it in some charts. My point being, right now, if you feel like you can survive where you are and sell all your investments, it might be the time to do it. If you can survive where you are, sell all your investments, wait for the market to do whatever it's going to do. It might rise, but I doubt it. The probability seems clearly stronger for it to fall than for it to rise. And then you can come back in when it rises, right? So anyway, if you're a risk neutral investor, normally I would say when we're heading into this territory, not coronavirus, I would say sell some stocks, sell some stocks, sell bonds, especially long-term bonds, buy short-term U.S. Treasuries, safest investment, or buy certificates of deposit, increase cash, which that is what cash is. Your bank will sell you a certificate of deposit and pay you 1 or 2% right now. There are better rates online, by the way, than there probably are at your bank. And you can open an account online right now conveniently. Check that though. I have not checked those CD rates, certificate of deposit rates in a few days. So time to check them again. If you are a risk-averse investor, you're careful, then you probably want to sell most or all your stocks. So bonds, hold cash, come back in when the market falls. After the market falls, and you're satisfied that you're willing to take the risk it'll fall more, or maybe you've started to see a comeback. When would that be? In a week? I cannot imagine. I hope I'm wrong. I hope the market rallies tomorrow and never stops rallying. But would that be realistic if I told you? There are people talking about certain individual stocks they think that would be good to buy right now who are on TV today. I could say I can understand that. If you are, again, in a position where you don't have a ton of stock right now, maybe you already got out, and now you are at a point where you could come back in, buy something, and take the risk that it goes down more, but you're not heavily in the market as it is. So now you're taking advantage of buy opportunities. That I can see that. I get that. But if you're in the market and you've been in the market and now you are withstanding this blow and the market is down so much, we'll look at that in a second. And if you think you can take more pain and then wait for it to come back because your time horizon maybe 20 years or whatever, fine. But if you think you don't want to do that because you don't think you have all the time in the world to wait for your stocks to recover, maybe now's the time to sell. Having said that, don't do what I say. Don't do things just because I say to do them. Consult with an investment professional, somebody you know, somebody you trust, or at least a second opinion before you do anything. Even though the market is moving very fast, Take the time to do that, so that when you go in, you're not just basing a decision to have surgery on what one surgeon tells you, right? We don't do that. All right, we've gone through coronavirus and the PE ratio. Now we're going to get into S&P 500 charts and the other items. But S&P 500 charts is next. Let's get into that. So here we go. The S&P 500 this year, today. Oh, let me fix this. This header is today. Oh no, this is correct. This is the correct title. Pardon me. This chart is for the year. Correction. They have today's result on the top left. That's why I put today in there, to help us remember. So today we had a fall of 11.98%. Let's call that 12% in the S&P 500. By the way, the Dow gets quoted more than the S&P 500, but the Dow is not as sound a measure of where we are. It's very, very close to this. This is the S&P 500 index. But here's why I choose the S&P 500 index. Not only I, but academics in general. When you take finance courses, this is the index that gets used and is considered the market portfolio because it contains 500 stocks, not just 30 stocks. And it does not just take their average. Dow Jones Industrial just takes the average price of 30 stocks. It doesn't weight the index based on which of those companies in the index have more shares outstanding, more value in the market. S&P 500 is capital weighted, market capitalization weighted. So it is a weighted index, meaning it really more accurately represents how much more of the economy is doing. Again, they're very correlated. Almost every day that the Dow goes down, the S&P goes down, and vice versa. The times when they don't match is when they're near zero. On a flat day, one of them or the other might go up or down. One might go up when the other one goes down, but that's rare. They're very highly correlated. But I'll tell you what, the correlation is not 100%. It's above 90. I haven't checked it. I know it's above 90. That's easy. But it could be 95-ish correlation. Anyway, let's use the real McCoy. This is the index I use. This is the index professional investors use, I assure you. And the index that academics use. Here we go. Let's look at this. So the record high was on February 19, 2020. I don't remember what that number was. 38 and change. We're going to see that number somewhere. And look what happened today. Okay, let's look at that again. Look what happened today. Today we went down a big chunk. And here's our summary. Year to date. Right? Here's our summary. Year to date, 26.1% from where we were at the beginning of this chart, way over on that side on the chart. And since that record high, on Feb 19, we're down nearly 30%. 1/3. Now, the market was worth 60 trillion. Forgive me, 40 trillion. I did a chart, and I meant to bring it in today, and I didn't stick it in. Maybe I'll pull it out and bring it in. We had 40 trillion of market cap in the United States. That's right. Before coronavirus, when we were at the peak. So 3 times 4 is 12. So we've lost 12. We've lost $12 trillion of market cap. Now, and today we lost 12%. Now, I must say this. I'm not a political, I'm not liberal or conservative. Okay. And I'm not going to be jumping on the president and the government right now too hard. But it is the time to say this. This is appropriate to say at this time. This is fair to say no matter who's in the presidency. When you vote for somebody to be president, consider a situation like this and consider that person's integrity, that person's focus on the world, not just on the United States, that person's focus on the whole country, not just on the people who follow them, that person's focus on the whole country, not just that news station that may follow them. Consider that if they think in terms of the whole world, if they think in terms of the fact that we are facing environmental crises, I know I'm sounding liberal right now because we do have a Republican, so-called Republican president right now. But again, don't get fooled by this. I am a capitalist, as hardcore as they come. But let me stay on my message. Consider the importance of what a person's personal life is like. And I know Republicans are going to say, yeah, like Clinton, he didn't have the best personal life. And I agree. When we vote for people, let's consider what their values are. Let's consider what their personal life was. Let's consider what kind of language they use and what attitudes they display and how they present themselves to us. Do they smile for us? Do they stand up for us? Or are they frustrated, or are they embattled? And do they spend a lot of time sending battle tweets? I've never heard that expression before. Did I make it up? Maybe. Okay. And so, on the other hand, I'm not naive. I don't think necessarily that some other president would have done way better. Maybe not. Maybe if we had Hillary Clinton as president right now, who knows what our situation could be, and who knows how Hillary might have managed it. I suspect she would have maybe responded better than Trump. But this has all happened so fast to all of us that I'm not going to jump on him too much specifically about this. I'm backing up and saying, let's remember this. I'm going to repeat that number I said a few minutes ago. That's why I'm on this. $12 trillion have been wiped out from this market. No matter how great any president would have been, it would have been a blow. It would have been trillions of dollars. But what a president that might have responded better might have saved $1 trillion or $2 or $3 or $4 or $5 trillion of value right now. Well, what do you care about a trillion? What is a trillion? Here's what $1 trillion is. There are 300 million Americans, a little more. Okay? 3 times 300 million is 900 million. It's almost a billion. So 3,000 is almost $1 trillion. $3,000 per person is $1 trillion. It's almost $1 trillion. $3,000 per person living in the United States is $1 trillion. But we lost 12 trillion. For every trillion that we could have saved that $3,000 per person already, and we're not through this thing. Here we go. More about the S&P 500. Now we're going to look at it from back in 1971, just to get a picture for what other blows it has received and give ourselves perspective. Okay. So again, I'm reminding us that number way on the top left is not from January 4th, 71 to March 16, 2020. That number up there that says today, where we dropped 324.89 points, that's today. But now let's look at the chart. The chart starts on Jan 4, 1971 to today, to today's close, March 16. All righty, let's see what we have here. The financial crisis of 2007 and 2008 resulted in a drop, not a one-day drop, but in a drop from peaks to trough of around 45%. This is not accurate. I just did this literally off this chart. I did not have time to go in there and find the peak and find the drop. I just looked at this chart and eyeballed it, and it looks like 45% to me. So it's okay if I'm off by a little bit, but it looks pretty accurate to me. Okay. We didn't lose quite half, but we lost more than 40%. That's why I just dropped it 45% for us. I just created this chart. This is the last chart I created before I came on today. Okay, in 2000 and 2003, again, same kind of idea. From 2000 to 2003, from peak to trough, we lost around 40%. And what was that? When the internet, you remember the e-commerce, the e-bubble burst, okay? That's what happened then. And that's what we have to sort of compare with. Point being, we just said we've gone down to how much? We have gone down year-to-date 26%, 30% off highs. That's very, very fast compared with these periods. Those weren't as sharp, but could we end up going down 40%? Yes. And would we recover? Will we? Yeah, more likely than not. Could we go down 45%? Yes. And will we recover? Yes, we see that. Huge recovery since 2009. Okay. Way back in 87, the worst single day occurred on Black Monday, October 1987. Here is the sign of the times they were in there. The trade deficit became a big concern at that point. It was a big trade deficit that got reported. The U.S. has had a bad trade deficit for a long, long time, and at that point, it became an area of very, very big focus. So that was one of the headlines that had occurred just before Black Monday. And the other one was merger tax breaks. Companies had ways of merging and saving a lot of money on tax by doing the merger. And think of it this way: if you bought a company stock and made gains on its stock, that was one way to get control of the company. The other way was to merger, and then you would avoid that gain in the stock market. You wouldn't pay tax on that gain. And they changed the rules to some degree, and that moved the market. And I don't remember if that rule has been changed back or not. That's what was going on there. Here we go. I'm sorry I could not get this. I did not have time to animate this so that each line would appear by itself. So we're going to look at single day records though. So just follow me. I like for each line to appear as I discuss it, but again, not enough time to create that animation where each key point pops up all by itself, which I love to do. So here we go. These are percent changes on this table. These are single day records for the S&P 500 index since 1927. Okay. Yeah, since 1927, correct. I wish I remembered to write that on here, but it was since 1927. Sharpest drop in the history of the market, 20.47% on that day. Black Monday, I guess it was, October 19, 1987. I just mentioned it. We just saw it there. This says 22.6 drop. This says 20.46 drop. Somewhere in there. Why it's not the same number? I made a mistake. They're supposed to be the same number. Okay, there could be other small mistakes here somehow because I threw this together so fast, but this is accurate enough for us to have this conversation. Pardon me not being perfect on those two numbers. That really, if I had more time and if I had someone else working with me, we could audit each other. Here we go. What was the next sharpest drop? October 28, 1929. That's the great stock market crash of 29 that was associated with the Great Depression. Okay. And today was the third worst drop in the history of the S&P 500 index by percentage. Now, let me remind you, a lot of people aren't used to thinking about percentages. What is that? It's per 100. 11.98% means $11.98 per $100. Call it 12. $12 per $100. $12,000 per $100,000. If you have $100,000 in an account, you lost $12,000 today if you're in the market and if your portfolio is roughly representative of the S&P 500. And how do you do that? You buy either a mutual fund or an ETF that mimics the S&P 500 because you don't want to go out there and do 500 trades so you can buy the stocks of 500 different companies. You don't need to. It's part of what I teach in this show and in this series. Okay. So the fourth worst day, single day, was a drop of 10.16%, October 29, 29. Again, can you imagine that on the 28th, look at this, it dropped 12.94%. On the 29th, the next day, I didn't notice that until now, it dropped another 10.16%. What a blow. And then in 1935, and there had been some recovery, and then 35, there was another blow, and the market dropped 9.97%. So we are up there. What happened today is historical. What happened today is serious. What happened today will serve us on many levels, okay, to get serious about coronavirus. Some people are talking about closing the market, shutting the market down. My man Kramer, I don't remember Mr. Kramer's name. He's on Squawk Box, and he's on with Carl Quintanilla on CNBC every morning. They're fantastic. They're my heroes. They're smart guys. They pay close attention. They really know what's going on. In fact, I don't know about Carl, but Mad Dog Kramer is an ex hedge fund manager, I believe, or investment banker, or both. He knows what he's talking about. So listen. However, Mad Dog came out and said maybe we should close markets. I don't think so. I think that leaving the markets open so far and continuing to leave them open, for one, gives people the opportunity to get out. Because if you freeze the market, they're not letting you out if you want to get out. And if they open it back up and it goes down again, now they might open it back up only when there's a lot of good news. So maybe it's smart to close it. But right now, I hope they don't close it. On the other hand, I can be proven so wrong. I'm willing to share with you how it looks to me and be candid about the fact that no one's positive, and I'm not positive about anything. Here's a luxury I have, though, that they don't have. Kramer is in front of millions of people all day, every day. Carl Quintanilla, my man there, what they say can move the market. And what I say is not going to move the market. What I say is going to just influence maybe a few people who I know who are watching, but I will say this. That means that I get to be more candid. And when things look tougher, I get to say it. Today, out of all the people who spoke in general, not just about markets, who spoke about coronavirus, I kind of kept count. I've been watching news all day nonstop while I prepared this presentation, so I could be well prepared to give this. And the 9 out of 10 people were speaking in support of the market and in support of us getting through this well. Only 1 out of 10 on average, my rough calculation, came out and said, we are in a new world. Things are changing. One gentleman came out and said he thinks the restaurant industry, and he's a restaurateur, And he came out, he thinks, and said, and this is one of the last things I just heard, he thinks it's changed forever. The days of us going out to restaurants as much is not going to come back anytime soon, maybe never. And I don't believe that. That felt like too much. But I appreciate somebody having the courage. If that's the way he sees it, that's the way he called it. Good for him. Or maybe he's trying to scare our administration into being more reactive, more responsive, or more proactive. Maybe that was the guy's name. Excuse me, game. Well, I don't know. Okay, here we go. Sharpest gains. Why am I putting up sharpest gains right now? Well, because this could give us a reassurance too, excuse me, that, hey, that could happen. We could have some great comebacks, but also it teaches us something. The sharpest gains are not as large as the sharpest losses. And there's an old saying that market takes the elevator down and takes the stairs up. And that's fair. It is tough. It's like exercise. It's like so many things, you know, gravity is gravity. It pulls things down and it doesn't relent. And nature is nature. The universe is the universe. And what we're doing now, if you love physics, you'll love this concept. What we're doing when we're creating market value, we are lowering entropy. We are lowering randomness. And it takes immense work to lower randomness, to lower entropy. Immense work, because nature is trying to rust everything, all of us. It's trying to return everything to pure randomness. In fact, it will. In the end, everything will be light. Nature will win out in some trillions of years. Okay, so we're fighting this force of nature and each other to some extent as we go down against nature. But usually we succeed. That's why there are more than 7 billion of us alive, because mostly we love each other and get along great. I know it doesn't look like that on the news, but remember this. Okay, back to the sharpest gains concept. The sharpest gains, don't fail to notice, are lower than the sharpest, at least the top ones. The sharpest gain is lower than the sharpest drop, not as large a number. But hey, then you have others. So on March 15, 33, this is back when the world was recovering from the Great Depression. There was a rally of 16.6% in one day. Now, reminder, the average return in one day is 10%. Excuse me, in a year. For the S&P 500 is around 10%. It's maybe a little less. But I take into account that we're improving. Like I was saying, our earnings power is improving. So I want to give us credit for being able to produce 10% returns, our companies in the United States. That's in a year, and this is a one-day gain. And look, these are all one-day numbers. This is sensational. Well, this helps you appreciate that stocks are risky. And this is the whole index. This is not an individual stock. An individual stock is far more risky than the whole index. So if you're a stock picker, or if you've got a friend that's telling you they've got a hot thing going on, and it's an individual stock, please be very careful. If you've got a $10 million portfolio and you want to throw $20,000 at something, go for it. If you've got a $100,000 portfolio and you want to throw $1,000 at some penny stock, have fun. But you don't take a $100,000 portfolio and throw half of it or all of it into one stock. That is not intelligent investing. Oh, even if you had inside information, don't do it. What do you mean? What do I mean? If you don't actually work for a company and you're not actually the chief financial officer who sat next to the person who consolidated the financial statements at the end of a quarter, if you don't have that level of detailed information, you are not in a position to make money with insider trading, in my opinion. First of all, it's illegal and it's immoral. More important than the fact that it's illegal is that it's immoral. But also, if you sat at a restaurant and somebody works for some company and they said that there's something terrible was going to happen to that company, and you went and out and you short that stock, you are so naive, because that person, you may have gotten up from the table and went and placed your sell order. By the time you got back to the table, you missed the great news this person shared that was inside information that was way more important than the bad news. Now you're short, and now the next day they announce earnings, the stocks rally, and you got burned. So if you don't have absolute current information, you have no business trying to do insider trading, and you have no business in any case. All right, anyway, here we go. Back to this. Sharpest gains. So 16.6%, and then in 29, and we see another one in 31. So somewhere in the 20s and 30s, when the world was very volatile, we see these big gains. 39, still very volatile. Now, September 5, 39, let me guess. Let me remember my history. Was that the day that Hitler invaded Poland? That could be. Okay, it's okay if I'm wrong, but now I'm going to remember something. September 1st. September 1st, 1939, Adolf Hitler, I believe, invaded Poland. You can correct me on that if I'm wrong. Why do I remember that? Because of it being that distinctive first day of a month and it being September. Okay, September 21st, 1932, another date. Notice these dates with these huge volatilities. How many of these dates were in the 20s and 30s? 1, 2, 3, because 1920 here, this March 16th, is not 1920, it's 2020. March 16th, 2020 in red is us now. It's not 1920. Okay. Anyway, so we've got 1, 2, 3, 4, 5, 6, 7, 8. 8 of these numbers are from the 20s and 30s. So what does that also help us understand? Crazy as this is, volatile as this is, it's not the Great Depression. And it's not World War II. I must say this. This is tough. But in World War II, in 60 months, 60 million human beings died. 1 million persons per month. Okay? That's what? 1 million persons per 30 days is 100,000 people every 3 days. That is 30,000 people a day dying in World War II. And these weren't, by and large, painless deaths, right? This was brutal, psychologically brutal, with bombs falling around them, civilians with bombs falling around them. I don't remember the ratio between civilian and military deaths, but the huge portion of that were civilians. You're sitting there, you're not carrying a gun, you're not fighting war, you're a child, you're a mom, you're a grandmother, you're a senior gentleman, and you have bombs falling down around you. Okay, single month records. Okay? In August of 1931, again, the 30s, the market went down 30%. Let's see when that worst day drop, that single day drop was. 1929, that was October 29. So boy, what a month they had. They had a terrible month of August and they had a terrible day in October. So August of 31, or am I looking at the wrong year? Wrong year. August of 31, yeah, forget it. Getting my years mixed up. Pardon me. So in August of 31, 30% drop in one day. Excuse me, in 1 month. Pardon my dyslexia. If you know me, you know I have no memory and I've got dyslexia. But I'm hanging in there for us. Okay. So then in February of 38, 1/4 drop, 25% drop in a month. April of 1940, that was early in World War II. U.S. was not yet in the war. 24% drop. Wouldn't be surprised if that was a time of bad news in Europe. April 40. Maybe I love history, so I'm going to take a wild guess and say the Blitz, not the Blitz, but when they were dropping bombs on London and dropping bombs in England. Maybe this is when that was happening. Okay, April of 32. Again, back to the Depression. 23% drop during that month. September of 1987. That was the month that contained that Black Monday. 22% that month. So far this month in March, we have lost 19.23%. Okay, we're not at the end of the month yet. We're right smack dab in the middle. Today's the 16th. Okay, sharpest gains in a month, 39%. So there have been some months that have huge gains. But this was again in the 30s when things were swinging like mad. In June of 32, another huge gain. So 32 had some huge drops, huge rises by month. Amazing. I'd never looked at this. I just created this and put it up here for us. March of 33, another huge gain. May of 38, all 30s. Every one of these big gains in the 30s. I did not know that. I'm seeing it now for the first time. And by the way, by the next show, I will double check every number here, and I will put back up the slides with the fix any number that wasn't correct. I'll put it back up. I may even go over these slides again because by then I'll have another market update. Okay. Yeah, these will be our standard slides. I'll just keep updating them, and it won't take me the time it took today because I had to set up spreadsheets and had to hook them all up and do all the calculations, and then pull them into this presentation. Here we go. Sharpest drops and gains for a year. 1931. What a year. More than half the value of the market gone. 2008, 40% of the market gone. The crisis of 07-08. Wow. What was that? Mortgage-backed bonds, right? Do you know that story very well? Mortgage-backed bonds, banks making bad loans, and then selling the loans off to investment banks, essentially, and corporate banks that were buying them and then selling bonds to buy them. And these mortgage-backed bonds start failing because there are bad loans in there. So now the bonds that they had issued, so they would create an entity, these banks. They would sell a bunch of bonds. They'd use that money to buy a bunch of mortgages. And as long as the mortgages were paying, this had been done for decades. When the mortgages are paying, that works. They take that money, and it's great that they buy mortgages. It frees up money for more mortgages to get made, right? So the local bank that's making mortgages gets to sell that mortgage and then make another mortgage. But then when mortgages stop paying because so many bad mortgages were in these packages, then these bonds crashed and the market crashed because it is. Can you imagine the value? I don't know the numbers right now. The trillions of dollars of mortgage-backed bonds that were out there. When you look at how much real estate value there is in an economy, it's trillions of dollars, and so much of that was backed by mortgage-backed bonds. Anyway, that was 2008. 37, it was the 30s, 40% drop. 1930, 9% drop. 2002, that was the bubble, right? The e-commerce bubble, the internet bubble. 24% drop in 2002. So far this year, wow. Now we're talking. Now when you look at what we've done, 26% in just 3 months, and not even 3 months, January, February, middle of March, we are really looking vulnerable. Vulnerable if you look at what our full year could look like. Sharpest gains, 61% in 1933. Wow. Crazy. 35, 57%, 28, 47%, 54, 40%, 54. The market was doing well 4 years before I was born. The world was changing and improving because the world was gaining momentum after having come out of World War II, and things were doing well. 1945, 37%. Well, the war ended in 45. I wouldn't be surprised if a lot of that rally happened as the people saw that the Allies were winning the war. Can you imagine what the world would be like if the Allies did not defeat Nazism? We have been through a lot, and we've made it through a lot. And really, Nazism only had one slender chance if they had gotten that atomic bomb before everyone else. But the U.S. got it first, and let's be grateful for that. So that atomic bomb is a nightmare for us to have. But isn't it ironic that it saved us, that we got it before Nazism got it? What a world. We are fascinating creatures, and history is fascinating. Okay, here's what I see. This is typical Al. Look what this title of this slide says. There are some immense opportunities. Our greatest, I should have written this on here. Every challenge that we have, our greatest challenges are our greatest opportunities. Boy, do I believe that. Even the challenge of when we know we're leaving this world, it's our greatest opportunity to be grateful, to go with dignity, to be prepared, and to prepare those around us. That is a great opportunity as well. Everything is a great opportunity when you know how to turn it into one. So what could happen as a result of this? Heck, I should have called this, I don't know, coronavirus blessing. I don't know, blessing in disguise, silver lining around the cloud. I don't know. I'm calling it opportunities. Do you think possibly that there will be more international political unity after this? Do you realize what a pain in the side Putin is for the world? And I'm not, some days I'm grateful for that guy, because in a country like Russia, if you didn't have a strong arm like Putin, that place could be chaos. We don't know, because culturally, historically, it's going to take them a long time to extricate themselves from communism. But on the other hand, maybe even Putin, China, the United States, all the major economic, political, military powers will become more allied with each other, because we, the people, will force it on them somehow, whether it's through elections here, whether it's through protests. If we have a lot of people dying going forward, somehow maybe there's a bounce back. If somehow coronavirus bounces back at Asia, because it's coming at us from Asia, maybe it goes back, bounces back to Asia, maybe it spreads around. What protests might we see? And what changes might we see? We might see some great changes. We might see the world become more democratic. We also, I'm afraid of this, might see the opposite. We might see governments buckle down. It's scary times, right? But I'm looking at it as an opportunity for political unity and stability. I did not put that in here. But that's how I choose to look at it, at least today, for the moment. national political unity, not only inside the US. What happened with Brexit? I'm disappointed about Brexit. I understand England's desire to get away from Europe because the bureaucracy in Europe is unbelievable. If somebody asked me, do you want the US to join the European Union, I would have said, no, not yet. So I understand England not wanting to be in it and escaping. But I broke my heart that they weren't able to pull it off. Wouldn't it have been wonderful? Would it not have been wonderful? Had England been able to integrate efficiently and with satisfaction into the European Union and stayed so that we could start thinking about creating a union here in the Americas and then eventually the whole world having a stronger union. Wouldn't that be great? So national political unity could improve, though, in the United States, certainly. I know I went into the international topic, but I'm back on national. We know that this has been, within recent memory, the most polar period, the most partisan period in U.S. politics, but do not be naive and imagine that this is our toughest political situation we've been in. When this country was founded, read your history, they barely kept this country together. They barely were able to eke out a what do we call it? A constitution. And before the Constitution, Declaration of Independence. And what was it called? There was another document of Congress, the Continental Congress, that organization. So we were first unified under the Continental Congress until the Constitution got created. And that took time. That took more than 10 years, if I remember correctly. And so why? Why did it take so long to create that? Because there wasn't the unity that people like to imagine. They think George Washington won the war, and then all of a sudden we had a constitution. Absolutely not. We've had immense political disunity in the past, and we've been through things like World War II. We've been through humanity survived the Spanish flu after World War I, which killed more people than the war. And there have been other episodes in Europe where a large percentage, the Black Plague, I won't remember when it hit, 2 centuries ago, I'm guessing. The Black Plague hit Europe, and something like a fourth of the European population went away. Now, shame on me, I shouldn't quote that number because I don't remember the number, and I'll quit doing that. I'll look it up before I quote any more numbers. Anyway, so what other opportunities are here? Preparation for future emergencies, right? We have now a chance to, instead of looking back and complaining to each other about whether or not we could have done it better, whether Hillary would have done it better than Trump, or whatever arguments may be occurring around the world on this topic, because Italy is facing stuff, Spain is facing stuff, France, who knows what battles they're having internally. I'm not keeping up with all of that, not yet at least. I'm lucky I can keep up with the U.S. I'm lucky if I can keep up with the U.S. But hopefully this will bring in an age where we do what I heard mentioned today by some medical professionals. We can have a governmental health system that has more beds. Apparently, we have fewer than 1 million beds in the U.S. That's a number I'm comfortable quoting because that's a number I heard today. And that is hospital beds, fewer than 1 million. And anyway, we can increase that. Our government can increase those. I won't worry about numbers right now. You get the point. We get the point. How about this? Will more of us become far more involved in politics now? For example, will more of us vote now? Maybe we will. Hopefully we will. And will we connect with our communities? Will we start caring about politics, not only at international and national level? Will we care about what's going on in our city? Will we care about what's going on in our state, in our county? I hope so. And won't this lead to more personal connection? First of all, immediately, what happened to me today? I was on the phone several hours with my family. I have not been on them with several hours I have not been on the phone for several hours with my family for a long time, right? But today it happened because of the market and because of coronavirus. We all checked in, and I must give you the update. Everyone in my family is well. We have some challenges to face maybe on the job front, but health-wise, we're great. And otherwise, we're great. We're doing great. And I feel so grateful to be able to say that. We have our challenges, but they look very manageable, no doubt about it. And we have each other, all of us in the Moral family. Okay, so what will happen? Will people have a more healthy lifestyle? Will they have watched their family who smoke cigarettes? And I'm not criticizing you if you smoke cigarettes. But this is a positive conversation. I'm saying, are you a person who's watching someone in your family who smokes cigarettes battle coronavirus? Well, some of the people that we know who succumb to coronavirus, I don't wish that on anybody. But if they do, will that motivate some of us to not smoke? How much healthier will we be if more of us don't smoke? And what kind of an environment will we be creating? And what kind of example will we be creating for our children and for other people's children? Because when we're out there smoking, not only our kids, other people's kids are walking by watching us, right? And if we're not smoking, do you sense that could be something that could be favorable for you, your own health, for those who love you? And and let's flip it the other way, do you know people who you wish with all your heart they did not smoke? Do you know people like that? I know people like that. I don't wish that coronavirus come along to stop people smoking. No, I'm not celebrating this, but I'm seeing an opportunity for us to think, well, not only of not smoking, right, but let's be careful how we drink and whether we drink and drive. How about this idea? How about exercising? How about all of those of us who exercising more? We're all in it. How about this? Would it be good for us to have more home education and more work from home? That could be better for family units. When I say families, I mean every kind of family. I don't just mean mom and dad and son and daughter. I want to make sure I'm clear on that. I am not an exclusive creature. If you know me personally, you know that, because I come from the south side of Chicago, and I am somebody that have in my own family every nature of creature who I adore. I don't love you. I adore you, the people in my family. And we come in every shape and size and flavor in the Moral family, for sure, which I think makes us unbelievably cool. All right. Pardon me boasting up Moras. Okay, here we go. But wouldn't it be great? I've wished for more home education and work, and I see the challenges. I see why it's not necessarily easy, convenient, and won't necessarily happen. But this could be a great thing. Why? Because technology lends itself for this so well. Now look what I'm doing. I'm online here. Okay, and I've been trying to push live seminars. I would love to do that, but I may end up only doing them online. And if I do them online, I will say this: if I do seminars online, they won't be for free like the Get MorAlpha Show, because those things are great. I have my seminar. I'll pitch it. The Investment Universe seminar. You got to see it when I put it online. It is, to me, sensational. All right, here we go. Back to opportunities. Environmentalism. Do you think maybe as a result of this, we may become more conscious of what's going on around the whole world, all of us, and be more willing to cooperate? Now I'm speaking to the whole world. I'm speaking to the countries that pollute disproportionately and then want to lay a lot of the burden of cleaning the air on America. We do deserve a lot of the burden. We do pollute more than the average human, but we do not pollute more than everybody. And I am not happy that we are not in the Accord. I wish we were in the Accord. I should remember the name of that. But this is the Accord of which some companies are members, which puts in standards, I'll call them. I don't think we could call them requirements, but they place goals and standards out there for each other, for themselves, and we're not a member anymore. I wish we had remained a member, but I also like the idea of us being in there, making sure that everyone toes the line, and we don't have the ability to influence that organization as much when we're outside of it. It would have been great to be in there and then use American influence to inspire the world to follow our lead in helping improve our environment. Who can do it better than we can do it? And by the way, who is we? Who is America? Is it us against them? No, we are everybody. That's what made this country the amazing, incredible miracle, really, that it is to me. Is everything about this country perfect? No, but who is more diverse than we are? Who has more ability to recruit talent from all over the world than we have? We don't even have to go out and beg people to come here. People want to be here. They want to come and get educated here, and many of them want to come and stay and live here. And then those who take their education back to their own countries with them, I say that's good, because economies, markets are like personal relationships. It's not win-lose. When you win and someone else loses, other than say a baseball game, but when you win and someone else loses on a personal level, you lost. The only kind of win that exists and on a personal level between two people is win-win. Win-lose is a loss. Win-lose is lose-lose. There are two really two results, two outcomes in personal relationships, in relationships between countries, and in relationships between economies. To the extent that the rest of the world succeeds economically, America does better. And if they get better than us and they beat us, that doesn't mean we would have done better if they had done worse. The better they do, the better we will do. Trust me, because the harder we'll compete. And also because the more efficient the whole world economy becomes, it synergizes with itself. We're more integrated every day. So don't be jealous of, and don't be sort of, I would call it patriotic, artificially patriotic about protecting like our education or our economy. Don't be a protectionist. Protectionism is a dangerous thing. There are only a few extreme examples where I absolutely endorse protectionism. Okay. When it's going to be an extreme military situation, protectionism, do it. If it's going to save lives and if it's going to save freedom. If you're out there and you want to be protectionist because you are against freedom, I am not for you. But if you are a protectionist because you believe that it will protect freedom for our children and their children, I am with you. But that's rare. By and large, protectionism is a negative for both sides. All right. So back to this environmentalism. I hope that somehow the other kind of connection that we gain from this crisis will cause us to be more conscious of each other and what we're doing to our planet. And then this is a huge one for me. I saved it for last. How much do you love to read and learn? How much do you believe in it? If you're not so fascinated by it, let me try to inspire you. Education and science, which to me is the same thing, and philosophy. I could have put that in there, but that's harder to squeeze into this conversation. Because to me, true science is philosophy and true philosophy is science. So anyway, education and science are so valuable. They're so rewarding, even only if you know more about what's going on in the world. And if you don't make one more penny because you love education and science, you will receive great gratification from looking into it and learning. Watching science specials on TV are pretty good, but I recommend watch videos. Watch videos about science. Watch videos about quantum physics, about cosmology, about biology. Go with those three right there. Those will lead you to never ending, to me, information and to me, gratification. And also, if you're a young person, you can find your inspiration there. You can find your thing that you dream, that you want to dream about. You want to get up in the morning. Believe me, professors, did you know this? The happiest people when you rate it by career. The happiest career in the world is to be a professional classical musician, not a composer. Well, many years, not every year, because the rankings change. But professional classical musicians, because they are so good at what they do. And look what they're doing, creating beauty for us. But the second most gratifying career is to be a professor, a college professor, a tenured college professor. Let's build more universities. Let's have more tenured professors. Let's be a culture, a species that is educated so that when the aliens come, we impress them, not only with our music. I love this, I must say it, that I think if the aliens come and they're worried about how terrible we humans are, when they hear our music, they'll give us a break. That's how great I think we are at music. I love all the arts, but to me, we have this knack for creating music, and I celebrate it and I love it. But back to education and science. I encourage all of us to believe in education so much that you are willing to really make your own personal efforts on every level, whether that means you're more comfortable paying more tax so that we can improve education. I don't mind if you only pay 1% more tax. I'm not being Bernie Sanders. Is that his name? Oh, I have no memory. Bernie, who is running for president. Oh my gosh. Bernie. Anyway, Joe Biden and Bernie. I'm not Bernie, or I'm not, I can't remember the name of our female nominee, Elizabeth Warren. I'm not that they are talking about programs that are so massive that I am worried about those. So I've said I'm a capitalist. I'm worried that if we give too much away too easily, first of all, we'll just bankrupt ourselves. We'll slow down the economy. We won't collect enough tax revenue, and we will be a slow-growing, backward nation. Backward nation. That sounds like a one-word word. Backward nation. And that will lag the rest of the world. And no, I don't mind if they're better than us. That's not the part that I have mind. But if we see that we're lagging them more and more, and it's because we're more socialist than they are, then I hope we wake up to that and be aware that a measure of socialism is very, very healthy, but not too much, like capitalism. To me, I'm more on the side of being capitalistic than not. But I know that if for example, I believe in progressive tax rates, not crazy tax rates. I don't believe that you should take half of what a billionaire makes. That's way too much. To me, progressive tax rates are good. Paying zero tax when you're way at the bottom is great, and a maximum tax rate of whatever. Do the math, accountants. Do the math, General Accounting Office. Do the math, economists. The max tax rate, I don't know. I'm not a tax expert. But if it were a fourth, the max tax rate, and the lowest is zero, something tells me if we just create tranches, if we just set the right income level for the right progressive tax rate, we could optimize the economy. We wouldn't be overtaxed. So the economy could run like Walter Payton. Not overtax the economy, but on the other hand, have progressive tax so that large organizations, large powerful corporations, and very wealthy individuals could cooperate more, could support education and science more, and all of the other social needs that we have. If they've benefited most from our culture and our society and our history and the sacrifice of our soldiers, then why not they pay a larger proportion? They're not going to miss a meal, and I hope they're not going to miss a night's sleep if somebody's worth 10 billion instead of being worth 20 billion. All right, those are the opportunities I see. Now, let's see what else I have. I said I would do return volatility, beta and alpha, and asset class comparison. Okay, this is going to be very fast. I'm going to fly through slides, and I've been on for an hour, and I'm going to be done in 10 minutes, an hour and 15 minutes. Okay, so here's what we're going to do. We're going to remind us that return is ourselves, and why? Why am I bringing this up? If you're done with the show, you're done with the show. Thank you for hanging out. I'm Al Mora of the Get MorAlpha Show, usually on 6 o'clock on Mondays. I was an hour late today because of the market emergency, because I rebuilt the presentation. But my normal time will be 6 o'clock p.m. on Mondays, and I am also going to be doing now other shows during the week. And I don't have a regular time set yet, but I will. I will set a regular time. Something tells me that maybe a Friday morning markets one would be great because a lot of important economic numbers come out on Friday mornings. And there are not that many IPOs on Fridays, if any. The Treasury doesn't issue bonds on Friday. So a Friday show sounds like a fantastic thing to be ready for the weekend and then just forget about the market, take a break on the weekend. That's it. I've just made up my mind. I will do a Monday morning show and I will do a Monday evening show and a Friday morning show. I want to be up with the market when futures are open. I mean a really early show. All right, so return. That's it. You're excused if you don't need to learn about return, volatility, etc. But for those of you who've not been watching my show, a lot of what I've already said today and what I will say on future shows is will have a lot more meaning for you if you can hang in here for another 10 minutes. Return is the way we measure profit in investing. It's a standard measure, and it is percent per year. It's how much a company makes per year, how much an investment makes per year, how much a portfolio makes per year. This way you can compare any investment to any other. If you have one investment for $2 million for a year and a half and another investment for $30,000 for 8 years, you can compare their return. You can look at the return for the one, return for the other, put them next to each other, not do any more math, and know who performed better. That's why return is valuable. It is percent per year. And when you calculate it, average income per year over average amount invested, and income is gains plus interest plus dividends minus losses minus fees. That's the average income per year over average amount invested. And if you had $1 of income on $10 of investment, your return was 10%. Volatility. A standard measure of risk, one of two. Measures how unpredictable things are. It measures how much earnings return. we're talking about return, is spread out. If return is very, very consistent year after year, volatility can be zero. If return is very unpredictable and it varies from the average a lot, then volatility is very high. And it's called standard deviation. It's called sigma. That's an old traditional way of describing it from statistics. The formula is for calculating volatility is standard deviation. That's a formula. This is a conceptual measure of standard deviation, of volatility. Standard deviation. This is not the formula, but conceptually, this is what it does. The formula ends up taking the average of actual return each period that you're measuring and subtracting the average return. So if the actual return year after year is way different from the average return, because you got -10, +10, -5, +5, -30, +30, okay, you've got big volatility there because your actual returns of -5, +10 are way different from the average. In my example, the average would have been 0. Okay. All right. And so an example would be if you have 30% volatility, that means the average difference between each year and the average for that particular investment is 30%. So for example, if you had plus 30% and the negative 30%, and then you get 30% again positive and 30% negative, your average difference from the average, because the average is 0, is 30%. Okay. And you can get rid of a lot of volatility by diversifying. But that risk that you cannot get rid of by diversifying is called beta. It's a standard academic measure of risk. Professionals use it. And that, again, I said it, you can't remove this risk by diversifying. And in theory, that's what beta is measuring. It's measuring the risk that you carry, that you deserve, for which you deserve to be compensated, because you don't deserve to be compensated for carrying a lot of volatility when you can get rid of that risk by just diversifying for free. So beta is the average change in stock return, your own stock that you own, compared with the change in the market return over the same period. So if on average you are in the same as the market, your beta is 1. And if on average your stock swings the same amount that the market swings, market goes up 10% from where it was, you go up 10% from where you were, then you are matching the market. Market goes down 10% from where it was, you go down percent from where you were matching the market. Your beta is a 1. But if you move more than the market, your beta is above 1, and below is less than 1. And it's not necessarily bad to have lower high beta. High beta is for investors. Buy high beta investments if you want to take more risk. You want to try to make more money. Buy low beta investments if you want to take less risk. Excuse me. All right. Here we go. And beta gets used to calculate expected return, and there's the formula. You can come back and freeze this at some time. But the beta of a portfolio is the weighted average beta of betas of its contents. That way you can build your portfolio to have any beta you choose. You can go out and say, I want this beta. I want the same beta as the market. Then you would find some stocks with lower than market beta, some stocks with higher than market beta, and you do a little bit of weighting, and you'd end up with your beta that you want for your portfolio. So that's very powerful that you can use beta to build a portfolio that has the amount of risk that you want. See, so maybe before this, you never even were sure what risk meant. Maybe you thought it meant how often you lose money. Maybe you thought risk meant how often you make less than 20%. You weren't sure what risk meant. Well, now you have some sense of what risk means. Alpha measures how well you did when you take into account your risk. So if your alpha is above 0, you're better than average. If it's 0, you're average. If it's below 0, you're below average. And alpha is based on beta. So if you have a portfolio with a beta of 1, but you made more than the other portfolios with that same beta, you have positive alpha. If you have a portfolio with a beta of 1, but you did more poorly than the average portfolio with a beta of 1, you have negative alpha. That's not good. Notice I named this show the Get MorAlpha Show, and I named my education entity MorAlpha, because alpha is everything in investing. Believe me, it is. So average actual return equals beta times actual market return plus alpha. So the way you calculate beta is through this formula, and you can also use this beta to calculate alpha. And then you can twist this same formula around, identical formula, just rearranged by putting alpha by itself. We isolated alpha, and alpha by itself equals average actual return that you got from your portfolio minus your portfolio's beta times the actual market return. And I have an example here. You would have an alpha of 1 if the average actual return you had were 10%, and then your beta is 1.5, but the actual market return were 6%. And that's the holy grail. A preponderance of investment entities pursue alpha. All right. So we've done that. Now asset class comparison. Here's what I did. I took this study somebody made. I made this chart with it. Okay. This chart shows how these 10 assets behave from 2000 to 2018. There you go. I made this chart, and what do we learn from this chart? That they tend to move together. Look at the black line. That's the S&P 500. Look at the red line. That's U.S. Treasuries. Okay. Those are two important assets. The S&P 500 is the whole stock market in the U.S., basically. And the red one is what the yield is that the government, U.S. government, paid on U.S. Treasuries on average during that period. Another way of saying the same thing is it's the yield that investors earned. And it's better to say it that way. It's the yield that investors earned investing in U.S. Treasuries over this period. But what you see is this. When we look at all these different asset classes, commodities, cash, I'm reading them. Global high yield bonds, emerging markets, U.S. Treasuries, global investment grade bonds, S&P 500, real estate investment trusts. They're just trusts that buy investment real estate property. And they really buy, companies that buy real estate property. Okay. Gold, and then Europe, Asia, and Far East stocks. If you look at all those, put them on a chart for that 18-year period, how did they behave? One of the important things to see is that in 2008, when we had the big crisis, the mortgage-backed crisis, everything went down except U.S. Treasuries. That means the only safe place to go was U.S. Treasuries. And in fact, they rallied for that very reason, because people go to U.S. Treasuries when they're scared, because it's issued by the U.S. government and it's a safe investment. So that's one thing you learned from that study. Now, I did a bunch of charts by building scatter plots. And here's what we're going to do. We're going to look at one. We're going to build a scatter plot chart. This is how we get beta and alpha and volatility for a stock. Okay, here we go. Here's emerging market stocks from that same data. We start with a table of data. There it is. We got emerging market stocks in one column, and we've got S&P 500 on the other column. And then for each year, it has emerging stocks returns and it has S&P 500 returns. Like the first year, 2000 is negative 30.6 for the emerging stocks and negative 9.1 for S&P 500. So for each row, we put a dot on the chart. Boom. The dot height is the asset return, and the distance the dot is from that line down the middle to the left and right is market return. So again, the height is asset return. The height of each of these dots on this chart, and the distance to the left or right is market return. So let's look at the first one. In 2000, emerging market stocks lost 30%. So that dot is 30% down from the zero line. Asset return is negative 30.6. And the S&P 500 lost 9% that same year. So that dot is to the left of the vertical line because the market return was negative. The market is the S&P 500. Emerging market stocks is the asset that we're looking at. All right. And then we do that for every one of these bullet points. For every one of these, we put the dot in there. And that's how we end up with this cloud. See, I had been looking at these clouds in prior shows, but I never showed how we built the cloud. That's how we built the cloud. I'm going to do it again very quickly. So you take each one of those lines and you take the return and you put a dot on this chart. And you start seeing a pattern that they kind of sort of move together. There it is. Emerging market stocks had a lot of volatility, so I used them for our example. Now we're going to look at a bunch of assets really quickly. We're nearly done. I cheated. 5 more minutes. Here we go. So what I did is I created, and this is volatility. This is the asset volatility. That purple bracket shows how spread emerging market returns were. They went as low as a negative 50, whatever, 53. They went as high as 79%. Okay. And then the spread of the orange on the bottom, you see that orange bracket on the bottom, the spread of dots from left to right is S&P 500 volatility. S&P 500's lowest year was 30% negative in 2008. And the highest year looks like it was 32% in 2013. So that's the volatility of the S&P 500. Okay, so that's where volatility comes from. Now, a regression, it creates a line, and that line is a line that best represents the dots. Okay, And with the line, you get a formula. That's the formula of that line. Okay. And that line, what it does is it has the least distance between it and those dots of any other line in the universe. And regression is just a mathematical method that you use that a computer does in a trillionth of a second now. You used to have to do it by hand when I learned regression. But anyway, so a regression just is a way of finding the line that represents the relationship between emerging market stocks and S&P 500. And so the tilt is the beta. And in this case, the tilt, look at the formula, is 1.2753, top left. Look at a formula that appears on the chart. It says Y equals 1.2753. That's a tilt. The 1.2753 is a tilt. It says Y goes up by 1.2753 for every 1% that X goes up. X is the market. Y is the asset. If you're confused, no worries. But here's the equation. Y equals 1.2753 times X, which means that the asset return equals 1.2753, which is beta, times the market return, plus 0.02, and 0.02 is alpha. So and correlation is 0.4995. That's how close the lines are, the dots are to the line. So if everything that were on the line, R squared, which is correlation, would be 1, would be perfect. 100% would be 1. To the extent that the dots are further from the line, R squared tends towards 0. Okay, but here we go. Now, U.S. Treasury bonds. We have a line equation, and we can look at it, and we can see that the tilt is negative 0.24. So that means U.S. Treasury bonds compared with the S&P 500 go down when the S&P 500 goes up. Correlation was pretty high. So, make a long story short, if you want to come back and see how I built these, you freeze it here and read each one of these lines. And I did that for all 10 assets: U.S. Treasury bonds, which has a negative slope; cash, which has very low volatility and beta; gold, which has very, very low volatility and very low correlation. The dots for gold are not near the line. The dots for U.S. Treasury bonds and cash are close to the line, especially cash. Gold, the dots are all over the place. Okay. Global investment grade bonds have some correlation. Pretty low volatility because they're bonds, they're not stocks. Commodities, a lot of volatility and very low correlation with anything else. In other words, no matter where the S&P 500 went, commodities were unrelated. But these are portfolio with half U.S. Treasuries and half S&P 500, which is what's called an optimal portfolio. When you blend Treasuries and the S&P 500, that's an optimal portfolio. Doesn't matter what proportion. It doesn't have to be 50-50. But when you combine U.S. Treasuries and S&P 500, in theory, that's an optimal portfolio. And what does that mean? It has the best return you can get for the amount of risk you're taking. So here we go. A theoretical optimal portfolio had medium volatility. It had high correlation because it had the S&P 500 in it. And that's what you're correlating to. Here's everything. I did a portfolio that had everything in it: medium volatility, pretty low beta, which means if you invested everything around the world, that's what your results would have looked like if you did it for that period. Global high yield bonds, pretty high volatility because these are global high yield bonds. They're risky bonds. They're pretty risky bonds. High yield bonds are issued by companies that are borderline having difficulties raising money. And they're at the edge where they're raising money and paying a very high interest rate. So they're called high yield bonds. Some people call them junk bonds. Sometimes we call them non-investment grade bonds. REITs, real estate investment trusts. Quite a high beta. No, excuse me, not really. 0.8 is not a high beta. But we can see that they're related to the market. Quite a lot of volatility. S&P 500, we regressed it against itself, and we're supposed to get a perfect line. So that's right. Y equals X. S&P 500 equals S&P 500. And correlation is 1. R squared equals 1, meaning perfect correlation with itself. Europe, Asia, Far East stocks, very strong beta, 1.07 beta, and R squared very high because the dots are clumped against the line. High volatility. Emerging market stocks, very high volatility and high beta, 1.27, the highest beta of all. And that's all summarized here. This is it. This is the last chart. Let's look at this. Here's how this chart is built. I've done other charts that only had return to volatility, but this one also added beta and alpha. So if you've seen this in prior shows, you know part of this. Now you're going to learn more of it. So these are the numbers that I just read you off all of those charts. So cash. Well, let's mention something very important. We're going from the asset that earned the least to the asset that earned the most. Cash earned the least. And what we see return, look at the legend on the bottom. Return is in green. Volatility is in red. Betas are in light blue. I divided beta by 5 to make the bars shrink them down. Otherwise, they were way too tall. But we can still see the relationship between beta and everything else. And then alpha is in dark blue. Beta is in light blue. Alpha is in dark blue. Now we're going to see. We're going to see if the returns and the volatility and the beta and the alpha, based on what we know about them, if they make sense from 2000 to 2018. All right. So I've ranked them by return. The asset class that made the least money is on the left. That's cash. The asset class that made the most money was emerging market stocks on the right. And if you look at only the green bars, look asset by asset, you will see that the green bars get taller. Every time we go from left to right, they get taller. But that is not true of any other color of bars. So that we can see what happens with volatility as return increases. Okay? Cash has low return, and this is low volatility, the red bar, scary bar, volatility. Then we go to U.S. Treasury bonds, and their volatility is quite a bit higher, but boy, their return is a lot higher too. Okay? But look at the beta, that's negative. Why is that? That's weird, but it's common, especially when there are big swings in the market, because the fact was we saw a chart you may not remember, and it was sloping down this way for you, this way for me, this way for you. It was sloping downward, and that means when the market rallied, treasuries did worse, and when the market did better, when the market did worse, forgive me, that's the stock market, S&P 500, when it did worse, treasuries rallied. Why? Because when the market was doing really badly, especially in 08, people bought that treasury bond, and it rallied just by virtue of the fact that more people wanted it, and it drove up the price. So that means that treasury bonds were a tremendously beneficial asset to have at this point because they immensely reduced risk, and yet they had great return considering you're getting return and you're reducing risk at the same time. That's not usually the case. So when markets are in crisis, maybe treasury bonds are the way to go, but be careful because there's a limit to how much they can protect you. And right now, that's where we are, I think. Treasury bonds have rallied like crazy because interest rates are so low, and that drives up bond prices. When interest rates drop, bond prices rise. There is that correlation is mathematical. It's unavoidable, but I won't explain it on this show. We don't have time. Anyway, so treasury bonds were a great investment at the time. Now let's go to the next thing, commodities. Look at the amount of risk. It just explodes, risk nearly 20%, but the return's the same as treasury bonds. Now that means that if somebody who bought treasury bonds made more money and had negative risk, was getting rid of volatility. Excuse me, I said something wrong about treasury bonds, though. They didn't have negative volatility. They had negative alpha. Okay, they had positive volatility, but negative alpha. So again, if I've been saying the wrong word, volatility and alpha, pardon me. That's my dyslexia. But let's go to commodities. Let's continue. They made more money than treasury bonds, but barely more. But look at how much more volatility. Huge, right? 3 times more. And so if you invested in commodities, you are thinking to yourself, why did I do that? I could have invested in treasury bonds. Now, global investment grade bonds right next door made more than commodities, and again, had way less risk. They made more than treasury bonds too, and way less risk than commodities, but more risk than treasury bonds. Look at this next one. They only made a little bit more than global investment grade bonds, which are safe bonds, investment grade bonds, they're safe. But Europe, Asia, and Far East stocks made only a little more, but look at the volatility. And they had a super high beta. And we'll think about beta later in a minute. Let's not think about beta too much. Let's go to a 50-50 portfolio with treasuries and the S&P 500. Some earnings there, not bad. A little bit better than prior. Those to the left. That side, that way on your side. And not too much risk. A lot less risk than Europe, Asia, and Far East stocks. I created a portfolio of everything in the middle, and that's what everything would look like if you did them all together. Everything on this page. If you did them all, just split it down the middle. 10 assets, 10% to each asset. You would have had a decent return. You wouldn't have had too insane of a risk, but you would have had some decent risk. Okay, your red bar. And then if you did real estate investment trust, gosh, you made a little more, but you sure took a lot more risk. S&P 500 straight away did a little more, but had quite a bit more risk in that period. But that volatility is about normal for S&P 500, and that return is kind of low. So it wasn't a good period because the average return was low. But the risk, as crazy as it looked on the chart, was pretty normal for the S&P 500. It moves around. Global high yield bonds. These are the riskier bonds, a lot of risk, but not as bad as REITs, real estate investment trusts, not as bad as Europe, Asia, and Far East stocks. So that's why people shouldn't call them junk bonds. They're riskier, but they're not junk. They're if you buy non-investment grade bonds near the top of the scale, just below investment grade bonds. That's Michael Milken is a person that got in a lot of trouble trading bonds, but Michael Milken, and he was using inside information. But Michael Milken was able to establish and teach people that high yield bonds are, on average, over time, better investments than people think when you consider the risk you take. And they had very low beta. Interesting. Their beta had a low correlation, so I don't get that much weight. Anyway, emerging market stocks, huge, big returns, but huge risk. Do you want to take that much risk? Maybe. You're also taking currency risk when you buy emerging market stuff, so be careful. Now let's look at beta. We're nearly done. We're nearly done. I know I cheated. I took way more than I said I would. And these shows have tended to be an hour and a half, and here we are. Okay. What you expect to see in theory is that beta would be pretty consistent with returns. That means that the green bars and the light blue bars would be pretty consistent with each other. And as we go across, the green bars are rising pretty smoothly, but the light blue bars are not. But ignore the light blue bars that have check marks in them, that have an X in them, because those had low correlation. Those betas weren't very useful. Ignore treasury bonds for a second, because that's just a unique aspect of treasury bonds that was not in the theory. Start with 50-50. So go to the middle above the word volatility and look at 50-50 US Treasury / S&P 500. Look at the green bar and look at the blue bar. Okay. And then go to the right to everything. And then what do you know? They both rise. And go to the right, real estate investment trust, and they both rise. Go to the right, S&P 500, and they both rise. Go to high yield bonds. Beta's not as high, but it's not as high as S&P 500, but it's higher than where we started at the 50-50 portfolio. Okay. We ignore gold, because gold is all about inflation. It's not about anything else. And go to emerging market stocks. And guess what? If you start in the middle and go to the right, we do see that according to what we would expect if we believe theory. If we believe theory, we believe that higher return is associated with higher beta. That's it. Now, I just threw return against volatility on a chart to see. And don't read the letters. It's too much. And there is a relationship in this period between return and volatility. But here's why. Normally, you can get rid of volatility risk by diversifying. And so the theory says you don't get rewarded for carrying volatility. But this period is one where you could not get rid of this risk by diversifying, because we saw the assets moving together a lot. So in that case, you got rewarded for carrying a lot of volatility. When we went asset class by asset class, there should be 10 dots, 2, 4, 6, 8, 10, 12 dots, 2, 4, 6, 8, 10. Oh, for 12 years. Right? I admit I'm confused with what 12 dots those are. But I do believe the story here. And the story is that, it is. It's 12 dots, because we also had the 50-50 portfolio. We had that other portfolio I created. What was the other one? Oh, the everything portfolio. Those are in here too. That's right. Okay. So we see that you did get rewarded for volatility. You got rewarded for carrying risk. And you couldn't get rid of your volatility in that period. So you should be rewarded for carrying risk. And then I looked at beta, and yeah, there was some correlation between beta too. Right? So this says that we're learning, we're looking at volatility and looking at beta makes sense. And we've done it all. We've gotten through everything. Now let me get on my main screen here. All right. And finish up by saying, if you saw the show, great. If you're watching it as a video, remember that, as a recording, remember that you can always pause and stop. And I hope you are not too worried about coronavirus, reasonably concerned, and in a mode of taking action, in a mode of standing up to this with your composure intact, with your integrity, in a frame of mind where you want to join the cause between you and your family, between you and your neighbors, you and your community, you and your country, you guys on the left. Listen more to the people on the right. They have very important points, like keeping taxes low and keeping government small and letting capitalism run, like I say, like Walter Payton. Please, on the left, remember that if you take away the incentives that capitalism gives us, your children who are going to end up going to college and becoming doctors and lawyers won't have as great an opportunity. So this capitalistic market also creates the economy that does create enough resources so that we can help people who are in need. So we can raise more revenue because our economy is stronger and healthier. That's my comment to you, those of you on the left, right? And those of you on the left who support abortion, I support you because that's what you want to do, all right? However, respect the fact that the people on the right believe in the right to life, that they stand up for that. And if they come at that with a bad attitude, if you don't like their attitude when they tell you that, I'm with you. I don't enjoy when a conservative comes with a negative attitude and says, I'm a right to lifer, and they're telling it to you with a glare. Well, if you're a right to lifer, if you love people, tell it to me with a smile. Tell it to me with caring. Tell it to me like you mean it, like you got some soul, like you believe what you're saying. All right? Don't tell it to me like I'm just your political enemy and you're always going to disagree with me on everything. Okay? So that again, I'm speaking to both sides. But I respect the right for standing up for the right to life, and I respect the left for standing up for the woman's right to do what she decides to do. I'm in the middle. So I support whatever our country decides. As a country, I am with you. I understand both sides. If you're on the right, have a heart. Have a heart. Let's be capitalistic, but let's help our minorities a reasonable amount. Let's help people in need a reasonable amount, right? In other words, don't just neglect them. Don't just leave them, because all the other cultures that came into the country, of one of which you might be a member, had a rough time when they came in, and then they became integrated. So if you're Polish or Irish or Italian and you're rejecting maybe African Americans or Latinos like Alberto Mora, if you're rejecting us, but I'm in the middle. I'm a European Latin guy, so I'm in the middle in every way you can imagine. And I think that's lucky on my part because it feels like I get along with people very well, and it happens very naturally for me. But maybe I flatter myself, but that's the way it feels for me. Anyway, back to this conversation. If you are on the right and you are not embracing the rest of the world, careful. We came from the rest of the world too, with those of us who see ourselves as Europeans who are here. And that's it. I think I've said enough. Let's hang together. And as Chris Guerra, my keyboard player from Freeverse, one of my musical heroes in life, and one of my persons with integrity that I know in life, somebody who I admire, who was a leader of my wonderful Freeverse band, an amazing band that I was lucky enough to work in for a long time, did thousands of gigs with Chris. As Chris said, we will all either hang together or hang separately. And the day he said that, boy, I laughed and I enjoyed it, and I'll never forget it. Thank you for that one, Chris. And wherever you are, Chris, I'm thinking of you and your family at this moment. I'm thinking of all of our families right now. And I'll keep coming at you. This is Al Mora, Get MorAlpha Show, Investment Universe seminars coming at you at some point online. Have a beautiful rest of your Monday evening.